This presentation is called A Guide to Market Recoveries, put together by American Funds, one of our mutual fund companies. Recoveries don't feel good. Bearish headlines, troubling events, and disappointing economic news fuels feelings of uncertainty and makes you want to react. However, in spite of times being extraordinarily difficult, there are times of great opportunity. Investors who found the courage and conviction to stay the course were rewarded with attractive results. We've highlighted two very different 5-year periods after a market decline. The first shows daily index values and headlines for the 5 years after the S&P 500s. That was in 1973 to 1974, the decline 48.2%. During that time, Microsoft was founded in 1975, after the decline. 1975, Microsoft was founded. Apple Computer was founded in 1976. ATMs were introduced. Consumer confidence reaches 109.9. Unemployment ends the period at 6%. And from 1974 to 1979, the average annual total return 17.39%. The next daily index value and headline for the 5 years after the S&P 500's August of 1987 to December of 1987, the decline 33.5%. After that time period, digital cellular phones were invented, World Wide Web development in Switzerland, British and French tunnels connect under English channels, the Persian Gulf War ends, formal end of the Cold War. From December of 1987 to December of 1992, the average annual total return 17.97%. After past declines, there have been strong recoveries. This next slide will show some of the strong recoveries. The very left column, or it would be to your right, no, to your left, to your left, to your left. Okay, to your left, periods of decline it shows, and then it shows the percentage of the decline. The next 5 columns are the first year low, second year, third year after the low, fourth year after the low, and fifth year. Then they show the average annual total return for the 5-year period and the growth of a hypothetical $10,000 investment during the 5-year period after the decline. Since the September of 1929 to the June of 1932 decline that started the Great Depression, history has shown that the 5-year period after the major market decline, although volatile, have generated attractive returns. The first cube shows the average of all the 5-year annual total returns after 16 major S&P 500 declines. The second cube shows the S&P 500's average annual total return from September 29 to June of 2010. Companies have been a driving force behind recoveries. Some of today's largest and best-known companies were founded during or shortly after a significant market decline, including Texas Instruments, 1930, Samsung, 1938, McDonald's, 1948, Medtronic, 1949, Burger King, 1954, Hyatt, 1957, Walmart, 1962, Nike, 1964, Microsoft, 1975, Apple in 1976, Amgen in 1980, and Adobe in 1982. Since June 30th of 2000, the beginning of the most recent lost decade, U.S. companies generally have increased their cash holdings. In the first cubicle, you'll see the increase of the cash holdings. This second cubicle, it is seen their profits rise, and the third cubicle increased their dividend payouts. Experience matters. In this slide, you'll see the growth during challenging times. It's a hypothetical $10,000 investment from October of 1974 to October of 1984, the 10-year period after the January 73 to October 74 market decline of 48.2%. In the 5 U.S. growth and income American funds in existence at that time, as well as the S&P 500 and cash. So you'll see the ending value and the average annual total returns to the right of this slide. As the excerpts and chart below show, challenging markets aren't, actually that's not below. You'll see American funds now and American funds then. American funds then, a lot of people are still afraid to invest. Intellectually, they know that the values are there. They know that on the basis of logical, time-tested measurements like earnings, dividends, and book value, many stocks are at attractive levels. But emotionally, they're not ready. We've been through some extremely difficult and frustrating years, and it's going to take time for the wounds to heal. That was a 1976 annual report. The 2010 annual report for AmCap now, the 2008, 2010, or 2009 period was one of the most frightening periods that most of us have ever lived through. But it is during these periods of strife, uncertainty, and trauma that the best long-term investment opportunities arise. In fact, we had a great opportunity to buy good companies at attractive prices when there was the most amount of stress and fear. Number 5, we're going to stay the course with a long-term action plan. Don't base your decisions on how you feel. Avoid the market timing trap. There's investor versus market returns and the perils of marketing time. View declines as times of opportunity. Depending on your personal situation, one thing you might consider is buying more shares of your mutual funds if you want to take advantage of investing when prices are low, but are uncomfortable with driving in all at once. Consider setting up a program where you invest the same dollar amount once a month. Although the strategy doesn't ensure a profit or protect against a loss, it's an excellent way to take the emotion out of what to invest and potentially take advantage of market declines because you're buying more shares when prices are low. Take small steps towards your long-term goal. Last of all, let history be your guide. Fear, panic, and uncertainty are common emotions investors feel during or after a significant market decline. But before you react and make changes to your investments, it's important to make sure you don't make decisions that you might later regret. This guide was created to help address common investor concerns and to assist in giving you a broader historical perspective of what's happening in today's market. So if your concern is it's different this time, throughout the history of the markets, investors have had to face challenges, panics, and crises. And while the past is no guarantee of future results, those investors who stayed the course were rewarded for the perseverance. You might say, how long will it take the markets to recover? Although there's no way to know when the market will recover, every decade since the Great Depression has had major declines in the S&P 500, and the 5 years following those declines have been characterized by attractive returns. I'm worried about the economy. In the past, innovations and strengthening company fundamentals have been among the driving forces behind market recoveries, and there are signs that these fundamentals are starting to improve. Your concern might be you can't make money during volatile markets. Recoveries can be time of opportunity. During these times, finding an investment manager with experience managing shareholder assets through many market cycles has helped make a difference in flat and rough markets. Your concern might be now is not a good time to invest or to be invested. Wanting to invest when the market is rising and to get out during a decline is natural. However, history has shown that over the long term, successfully timing the market is impossible, and investors can be better served by diversifying their assets and staying invested during all stages of the market cycle. Thank you for watching this presentation. I hope it was helpful to you. Hang in there. It's going to get good.